Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
Hello everybody, Steve Waters and Victor Kumar back again for another Investing Insights with Right Property Group in the studios. Today's the filmed version again. And Vic, it's been another couple of weeks since we've done this. Well, actually, three weeks now because we missed the last one. And we've seen a rate rise.
I know, when everyone said that it was peaked, right?
Yeah, we've seen more data come out and tell us just how dire the situation is and how much life sucks and how much it's going to get worse.
The doomsday sayers are out.
The doomsday preppers are out. But we've also seen some green shoots in terms of the supply and demand metrics, which we'll get to a little bit further down the track. But what's been happening? What's your vibe? What's your take on the market as you pound the streets?
Look, it's business as usual, right? Forget about the headlines. Forget about the doomsday preppers. Good quality properties, good investment properties, investment grade properties are selling for premium, and properties are still going above listed price. And this is totally contrary to what all the articles are saying out there, where a higher interest rate would determine that you'll have more properties sticking on the market. But that never is the case. Even the yesteryear, Steve, at the high interest rates, properties doubled.
But can it change? Could it change?
It could.
I mean, there's a big tipping point in terms of affordability now that's starting to rear its ugly head. And of course, the RBA governor has said potentially expect more rises.
Well, what he said was get another job
and share your house. It's which, you know, if you took away who he is and what his role is within the economy, and you had your father telling you that, it kind of makes sense.
Yeah,
right.
Absolutely.
Now, complaints to 1-800 Victor this time. It's there's a certain degree of logic behind what he's saying. Yeah.
And that comment was taken out of context when you look at his entire commentary.
Correct. But that's the media's job.
That's right.
Right. Let's just take a snip of it and we'll wrap it around something else and make it look good, bad, or ugly.
Yeah.
But there is some merit to when you take the full commentary in context. There's a bit of sense behind it.
Absolutely.
Yeah? And if we go back to some of those other times that we've experienced where there's been some absolute uncertainty within the economy, both, I guess, from a confidence piece, but also economically, people did whatever it had. I mean, even if we, in my head, I was thinking about the GFC, but if we even bring it closer to that and talk about the pandemic and the lockdowns and the uncertainty, the amount of side hustles that people had was
next level.
Unbelievable. They did whatever it took to potentially survive, and I think a lot of people will do that this time. But there are some things that I believe anyway. There are some components of today. No matter what you do, you can't create something out of nothing, and we're really talking about accommodation there.
That's true.
A roof over people's head.
Yeah, and when you look at it, Steve, any economy, any phase of the property cycle, there's three distinct groups, right? One that's absolute, bury my head in sand. This is bad. I should not invest. I should not buy. I'll sell everything to stay out of trouble. Then the other group is the one that want to do something, but they simply can't because they can't get finance. They don't have the capital. And the third is, okay, market's changed. What's my opportunity? How can I adjust my strategy to take advantage of the market itself, right? And I guess the middle group, which is I can't qualify for finance, a lot of them would be where they haven't actually got the education around them to look at how they can actually qualify for finance, because they're perhaps going with the big four, or they're going with the bank that they've always banked with. And when they say no, they throw their hands up and say, well, I can't borrow.
Do you know, I'm a member of a forum, and it's funny you should say that. I'm a member of a forum on one of the socials for giggles, I guess. And it's around, I won't mention the group, but it's the theme of the group is around how to save, how to budget, how to get by, I guess.
Yeah.
And this particular forum has hundreds of posts every couple of days. Like it's a very active forum, and no particular asset class. Yeah. And some of the comments that in the form of a question, and then the comments in the form of an answer to these questions amazes me. Like in terms of just how wrong I believe people are seeing the situation. I'm not talking about today. I'm talking about generally. Like you go back 4 years on this forum, and the questions, the themes are the same. There's a real lack of financial education within the ecosystem.
Yep.
And then what happens is, thanks to social media platforms, you get this forum full of all these questions with people giving their opinions / brackets advice who are just as, I won't call them uneducated, but let's call them as financially aware, where these people then take that advice / awareness as what to do, and down the rabbit hole they go. Now, that's my negative view on that particular forum. There is some positives to the forum. So if I want to find out who's got the best electricity plan, I can go into that forum and I know that there's 2,000 people that have gone next level and deciphered every energy supplier's plans and who to take. Same with not so much insurance, but whatever it may be. So there's pros and cons to it. But my point is, there's a lot of people, this comes back to your commentary around people burying their heads in the sand and throwing the baby out with the bathwater, like legitimately. And I think if you bury your head in the sand, you'll pay the consequences somewhere.
That's right. And burying the head in the sand doesn't necessarily mean just ignoring what's happening. It's actually not taking action, right? And looking at all of the moving parts within a portfolio, your household budget. Because as markets change, as economy changes, you need to make those adjustments regardless of how well heeled you are. Now, for those that don't have as much disposable income, with the interest rate rise and all that sort of stuff, inflation is a big thing. If they don't have that much disposable income, then they have to cut hard, and they have to cut aggressively, right? The ones that have a lot of disposable income, this is where the tipping point does come in, where they become complacent, right? Because they don't feel the hurt, and they leave the run a bit too late, right? And one of the things you and I do is we sit down with people of all walks of life, right? And we take the same fundamental approach with everyone in terms of their portfolio, in terms of, okay, we need to look at the moving parts and we need to address them. Now, whether you need to take assertive action or not is totally dependent on the portfolio owner, but we need to be looking at it from the same template, regardless of what walk of life you come from.
Absolutely. It's and when you sit with the clients, as I do you see a theme, a common theme, or do you see a theme that's quite different from people that have got an established portfolio to those that perhaps have only started in the last 12 to 24 months?
If they've started in the 12 to 24 months, right, a lot of them, despite us telling them, despite us documenting with them, and when you do these plans with them to cater for the high interest rates, psychologically they haven't taken into account. They're still stuck in the 2.99s, the 1.99s, right? And when the rates have actually come up, there is a psychological hit, but a well-educated investor takes all of that in their stride. And so taking that bit aside, I think that whether it's a new investor or whether it's an established investor with multiple property portfolios, the problems, perceived or otherwise, is still the same in the portfolios.
It's always cash flow.
Yeah, exactly.
It's not even the equity position.
No.
It's always cash flow. And I would, if I sit back and think about it, those that started investing or had experienced, say, the GFC, are probably, they still carry the scars. Yeah. Right. And I guess anybody who lived through that or borrowed money through that or invested through that, no matter what the asset class was, if you were just in the working, if you were working at that point in time and had to have responsibilities, I think people carried the scars through forward to today. Yeah. And they've positioned themselves accordingly. Obviously, there'll be a certain cohort of, that'll be water under the bridge and they've forgotten all about it. But I think the smart person said, right, this is what can go wrong. This is what may or may not go wrong, but here's how I'm going to mitigate my circumstances for that. They're still aggressive in the way that they invest, but in a conservative fashion.
Yeah.
Now, that may sound like I'm contradicting myself, but I guess it's all really around contingencies for the what-ifs, such as buffer, liquidity, et cetera, et cetera, et cetera.
So you're planning for the worst, but aiming for the best. That's what a true portfolio is.
Yeah, and you're taking advantage of situations when you need to, or when you can.
When you can.
And that when you can, I guess, is today's subject, and that's all around finance.
Yeah. The oxygen for property investing.
Or the center of the universe for everything, really, isn't it?
Money
Finance
makes the world go round, right?
Well, it does, whether we like it or not. Yeah, it is. Yeah, right up there with oxygen. Fortunately or unfortunately. So today's subject, Vic, even though we kind of skipped what the markets are doing, because I think we all know what they're doing.
We all know.
Yeah, it's so the 5 absolute finance musts to protect and enhance your borrowing capacity. Now, I guess there's a certain, I'll put a disclaimer to it or a caveat to that subject, being there are going to be components and circumstances where you just can't do anything no matter how tight and fiscally responsible you are. Serviceability is serviceability. If you've capped out, you've capped out. There's not much you can do, so it's a matter of sitting on your hands, enjoy life, relax. Maybe monitor and manage what you have and get yourself into a position. But for the majority of people, there is still finance available.
Yeah.
There is still opportunity available because of that finance. So it's how do we enhance it? How do we protect the finance position, but also how do we enhance it? So thought we'd go through five points. And I guess the first one is the obvious one, and that's all around income and expenditure.
Yep, absolutely. And before we go into that, one of the key things we need to remember is that there are 400 plus registered lenders in Australia, right? So first and second tier lenders, and then there are the third tier lenders as well. Why I bring that to the table is that often when we talk to a broker, and again, the instructions you give and the vision you impart to the broker determines how hard they work to get the solution. So if you're not giving them the right instructions, they may just go to the big four, or you may give the illusion that, hey, I just want to deal with the big four, I just want to deal with the first tier lenders. So you're capped, right? You're very much limited. Whereas if you turned around and said, I want to look at how I can free up a bit more money in terms of cash flow from restructuring my existing mortgage to enable me to hold another property without putting added pressure on my cash flow. And those things can happen by consolidating loans, by getting products, turning principal and interest into interest only. So what you're doing is creating the cash flow from within your budget as it stands right now, without rather than adding more negative cash flow to it. Now, it doesn't always work 100%, so it may be a blend of, you know what, I can afford $100 a week, but I can also create through restructure $200 a week from this, and therefore my property holding cost for the next one is around $300 a week before tax.
That's a number.
Yeah, that's a number.
So there's, I guess, on that point then, it's really knowing what you want to achieve from the asset class and from a high level point of view. So whether I want one property or 101 properties, the broker needs to know that. And I say broker deliberately, but the broker needs to know that, because if your plan is one property and one property only, there's nothing wrong with that. Then it's going to be potentially different lenders, different structure.
And maybe more interest rate focused.
Correct. As opposed to someone where you want to re-leverage, recycle, et cetera, et cetera. So the broker needs to know the goals. The broker needs to do what you're doing.
Yes.
I think is very, very important. And your broker needs to collaborate with your other team members, which we've talked about. But the first point, Vic, is income and expenditure. Now, for a while that sounds like a pretty obvious comment on something that you should look after, it amazes me how many people don't.
Absolutely.
And they do as a reaction, but not as a planning piece, which is quite important. So with the income, ourselves are our biggest assets. We know that. If we have investments, whether they be shares, business, property, obviously they form part of the income as well. And our expenditure, quite obvious, our biggest one is going to be our mortgages. It could be non-deductible debt, which we'll get to in a minute, and it could be our household day-to-day living expenses. Yeah, it could be where you live and how you live, right? So when we get those two metrics in terms of income and expenditure somewhat right, it does open up our serviceability capacities, but it's very easy to say it. Doing it is a very different
one
question.
of the things when you're going to a lender, right, is they actually look at your spending habit, right? And if you
forensically,
yeah. And I remember the days when this had actually changed. They had gone so granular on it that if you had dinner at RSL or a Catholic club twice, 3 times a week, they assumed, because these were licensed premises where you could also have the poker machines, they assumed that you had a gambling problem.
I had a client exactly that, like he had nearly $500,000 income earner, and he got a loan knockback. This is during COVID. Got a loan knockback because of that very reason. Was meeting his mother-in-law, his mother, who was retired, at the local club once a week, and for that reason they thought he was a gambler. Yeah. So he had to write a very detailed letter with proof to show that he wasn't a gambler. Is it that bad now? No. Could it be? Will it be again? Probably. Yeah.
So you need to put the right story around the data that the bank is going to see, right? Because at the end of the day, first of all, there is 2 levels of approval. One is the automatic approval. And if you hold multiple properties, chances are that you won't go into the automatic approval realm. Yep. Then the second is where it's actually a physical person doing the approval. And this is where your broker needs to put the right story around the data so that it interprets what's on the page to real life, as opposed to the person approving the loan creating their own story on the data.
And the credit policy officer, if you really wanted to break it down, their job is to find a reason to say no, to protect the risk of the lender.
One of the KPIs of a credit officer is how many files they move across the desk. What's the easiest way to move the file across the desk? Yeah. Say no.
Exactly. Yeah. Or ask for more information and just put it to the bottom of the pile again. But you did mention something really pertinent there, and that's around the business plan. Like whether you're starting out or whether you've got an established portfolio, when you go for lending, when you go to borrow money, the broker will, I guess, in a very simplistic fashion, package it up as a business plan to the multiple different lenders. Because you mentioned it, like there's a difference between an online application, run the numbers, you service, versus them putting it in front of a
credit officer.
Credit officer who goes deep, especially if you've got multiple different structures with different volume of assets with
unusual income,
unusual spending. It all adds up to quite a complex situation. And so once again, coming back to the beginning of the subject, I guess, is the complexity and the sophistication of your broker needs to match your own sophistication.
Absolutely. And you do outgrow brokers, right? You do. A lot of people start off with the broker that got them their first home loan, their home, right? And chances are that may be the wrong team player, because they specialize on the home mortgage as opposed to investment. And this is where truly, like you said, Steve, we need to sell them the bigger picture so that they can focus on the bigger solution, as opposed to what most people do is go to the broker and say, I need a loan for $600,000. I'm planning to buy in Brisbane. Right? And the broker then goes in, what's the average yield in Brisbane? 3.5%, 4%. So that plugs in that number, and then it spits out an approval where you can't really make it fit to a actual property.
Correct.
Because the rent requirement is too high, because you've said, I want 600,000. So they've bumped things up to get to that higher approval amount. So you need to look at all of the other conditions. Maybe that, you need to close down 1 or 2 credit cards, and that credit card could be a business-related credit card, which, has happened to us before, in the sense that often because the credit card is under personal name as a director, it gets pulled into the personal assets and liabilities. So the story needs to be put around it and proof put in there to say that, hang on, this is actually the business expense. This is totally used for business. And therefore they can safely ignore that credit card debt.
Which takes time.
It does take time.
if you're doing it as a reactionary piece. But if you're pre-planning all of this because you've got a good broker with the questions that you're going to be asked from the broker, from the lender,
Yep.
you'll have all this information set, I guess, or ready to deploy to whomever it may be. And I think coming just back on to the income and expenditure side of things, it's really important that you start as you mean to continue. So if you're an investor as such who's looking to purchase, let's call it the new year, somewhere in January, February, then what you do today is pertinent to what your result will be.
Oh, absolutely.
So it's like, get it right now. So drop those subscriptions as an example. Get rid of the non-deductible debt.
Yep.
Take the overtime, whatever it is.
Less
that you've
Uber
got to
Eats.
do. Yeah, less Uber Eats. Less Uber, full stop. I was going to go into a soapbox there with Uber, but I stopped myself. But all of these things, if we do it now, then we're setting up good historical evidence.
Generally, the bank looks at 6 months worth of history.
If you can do it for 12 months, you'll only benefit as well. So start as you mean to continue and get all this right, income and expenditure. So the second point, Vic, is, I guess, part of expenditure, and that's repayment structure. So really what we're talking about is interest only versus P&I.
That's right. I think, and then given this rising interest rate climate, and particularly if you're with a second or third tier lender, generally the second or third tier lender does not automatically adjust the direct debit payments. So as your rates go up, be mindful of the letter that they send you. Actually open the envelope and read it as to whether you do need to take action or not. Because what it has a direct impact of is have a blemish on your credit rating, because now your credit rating has got immense data matching in terms of your repayment performance. So whether you're 1 month late, whether
1 day late,
1 day late, it all gets logged onto your credit rating, and therefore your score, your credit score, gets reduced. Now you want to be in the green section, the excellent credit rating as such, right? And this is where it determines which lenders open up to you in terms of how well you manage your money. What banks are looking at is how well do you manage your money? In other words, how well are you going to repay me?
Yeah, how do they, and they're just mitigating their risk at the end of the day. And that's a really good point, because repayment structure isn't, even though it's the majority, just about principal and interest versus interest only. It's about
managing the whole thing,
managing the structure, which is your credit file at the end of the day. And there's been multiple instances where I've seen people miss their repayment by a day because of whatever the reason, and 99.9% of the time it's because there was just a technical fault somewhere,
or the rent's dropped in late in the account.
Correct. Right? And it was like 30 days worth of explanations, but it's already there. You've put that element of doubt into the assessor's eyes, and so they may dig deeper. You really want to fly under the radar, and if it means paying a little earlier to not have your money in your offset for a couple of extra days, I believe it's far more beneficial to be doing it that way. Make sure your payment on time and everything rolls sweetly, than having an extra couple of days in an offset, as an example. Yeah. So that's the credit file.
We talk often about having buffers, right? And reality of it is there are two buffers. One is the holding cost buffer, which is the how much cash slush fund you've got sitting aside, right? And depending on where your portfolio is and depending on how much you earn and what your psyche is determines what that number will be. Then the other buffer is where the buffer that needs to sit within the account that has all of the direct debits. So you need to have, you need not be reliant on the rents dropping in time for the direct debits to go through.
So you don't get caught out.
Yep.
Yep, 100%. But the big one is interest only versus
principal and interest.
And there's arguments for both, for and against. But in today's environment, well, in any environment, cash flow is king. Cash flow management is king. Big difference. And most investors will want to go interest only. There are times, however, to go P&I.
Yeah.
But the big thing, if we take today's environment and what's been, I guess, shaping us for the last, I want to call it 2 years, to get to where we are today in terms of the rate environment, is just remember this. If you're interest only and you're doing it easy and you want to go principal and interest, it is a phone call to go from interest only to principal and interest. If, however, you're principal and interest and things get a little tighter and you want to go interest only, that's a full application.
Yeah.
So let me say that again.
With most lenders.
With 99% of them. If you're interest only and you want to go to principal and interest, it's a phone call. If you're principal and interest and you want to go to interest only to preserve more cash flow, that's a full application.
With full assessments.
With full assessments. And the problem with that is when you've realised that you need more cash flow and you want to revert from P&I to interest only, a lot of the time the horse is bolted.
Chances are that you haven't paid your credit card off. Chances are that you may have missed one payment.
Or even if it's not that, even if it's just like you can foresee what's happening, the credit environment and the assessment has changed, so you probably won't service at that point in time to go from P&I to interest only. Probably. It's a bit of a guesstimate. So making sure that you have the cash flow management tools before you need them is essential. So this is where you're always focusing on the outcome, but based on where you are now and where you think you're going to go. So once again, I mentioned 2 years ago, a year ago maybe even, or a bit longer would have been a perfect time if you had your eye on the ball to see where the credit environment was going to revert from P&I to interest only. Then overlay the interest rate cliff or fixed rates and so on and so forth, and it would have been prudent and good management to do that. Now there are some of the lenders will assess you differently on an interest only scenario as opposed to P&I. That's something to have a chat with your broker and also where you're going.
Yeah, and be mindful that in an environment like today, lender policies change on a daily basis, right? And your conversation with your broker 6 months ago may no longer be valid. There may be options for you now. So it's really prudent that you check in with a broker every 2-3 months to see whether there's been a product change that will enable you to restructure your repayments.
And we're seeing some of those now. So we're seeing that with Westpac. Some of the third-tier lenders, a couple of the second-tier lenders are making these small adjustments to facilitate APRA. Get more money into the environment and also to help people with their mortgages, because at the end of the day the banks don't want to see you crash and burn
because they lose money as well.
Yeah, it's not their business. Yeah, it's literally they want to see you prosper. So repayment structure is crucial in the big scheme of things. Even if you forget about, just to close that point out, even if you are not even thinking about borrowing again in the short future, just as a cash flow management tool, it makes absolute sense.
It does. And I think one of the standard non-educated approach to investing is that I want to pay it off, right? And therefore I want to go principal and interest. At this point in time, because of the shortage of supply, because we have immense shortage of supply, and we know that once finance is fixed, there will be a run on property prices. Whether it's tomorrow, whether it's in 5 years' time, we don't know that.
Next Friday at 3:30. Apparently.
So when you've got loans at interest only, it may allow you to control one more property, or it may allow you to hold on to your properties at the moment, and you can bet that the growth that you'll have will be bigger than the principal amount that you can pay down in the next couple of years.
I was thinking driving in today that because this is a filmed version, it would be really cool if we could actually somehow get the producers to be able to allow us to have some sort of digital whiteboard so that you could, when we're talking about like that, we could show it, write it, draw little pictures like we used to. Anyway, I digress.
You miss your doodle board.
Yeah, back in the day before COVID, where we were in the boardroom every day, the budget for texters.
It was next level.
It was.
Yeah.
It was. All right, so the next one is, we'll call it equity harvesting, but what we really mean is liquidity. So that particular phrase, liquidity, we have been talking about almost every single podcast for 15 years.
Yeah.
Literally. It is such an important piece of the puzzle. However, what it can do is also affect serviceability.
Yeah.
If it's not pure savings, let's say it's equity harvesting, as we mentioned in the point. Now, there are many benefits to equity harvesting, whether it be from a leverage point of view to use as deposit and closing costs for when the next investment asset is purchased, whatever it looks like to you. But in today's environment, for those that aren't in a position to borrow, even though they have the liquidity or the equity parked aside, it's a great buffer. It's a great psychological piece of the puzzle.
Yeah.
But you've also got the pot there. You might divest into something else. It could be, I don't know, high frank yielding dividends or something like that. I don't know. But the state of your wallet dictates the state of your mind. And so when you have the pot there, you think more clearly. You rest easy. You sleep better.
Because you've got the money tucked away.
Because you've got the money tucked away.
Yeah.
You're not backed into a corner to make, I guess, silly decisions or reactionary decisions because of the pressure put upon you.
Yeah. Yeah.
So it's important to have it.
Yeah, and I think it's important to point out that it is harder to access equity in times like this because of qualifying rates, because your cost of living has gone up. So we really want to have that equity liquefied well ahead of when you need it, so that yes, you might not use it at all, or it could be that there's an opportunity for a lifetime. Equally importantly, and this can be very dangerous in the wrong hands, you could, while things are very tight, let's say you had a baby, you're down to one income, you could use a little bit of the equity to help hold on to the greater portfolio so that you don't have to prematurely sell and see out another cycle. Now, the reason why I say it's dangerous in the wrong hands is that if you're not disciplined with money and you have got your equity liquid, you tend to spend, you tend to buy the Tesla, you tend to go for that holiday, you tend to buy that expensive suit that you wanted, right? So this is where you need to have a clear divide in terms of the money that's for investing and for rainy day, and the discretionary spending money.
Which makes me think of the offset facility, like the 12th wonder of the world.
Yeah.
Which is a fantastic tool, but it's also a very dangerous one in the I guess, the undisciplined person that has that money. But you mentioned something really interesting around, if you look at it from if you have the liquidity, if you have the equity harvesting pot set aside, let's call it a buffer, because we don't want to invest anymore for the short term. If we go back to the GFC, right, which was really that was a defining moment. That was a defining moment, yeah. It, I was looking for the words there, but you
stole your thunder again.
Yeah. It's so if we look at that and we look at, and we've mentioned this before, but we'll say it again now. If we go back in time and we look at the people that had to sell the properties, I'm talking about the general public here, the consumer. For those that had to sell the properties, it wasn't because of a lack of equity, it was because of a lack of cash flow. Yeah. Now, had they been able to, whether it be via education or they had a buffer in place to be able to retain those property, and you fast forward from that moment through till today, and they've like quadrupled in value, right? Like, that's a huge, immense amount of wealth that they have missed out on. Now, they had to sell for a reason. Once again, probably lack of cash flow management. Had they had the buffer or the equity harvest, it would have given them the opportunity to be able to eat the buffer, I guess, to survive. If they had
and not miss out on the quadrupling.
Yeah, if they had the foresight and realised what is potentially going to happen over a period of time. So it's very important that you have that buffer set aside via equity harvest in this particular case, so that you can survive. Is it something that you want to do? No. But to be very clear, what we're not talking about here is living off equity. Yeah. Right, which is one of those.
Yeah, absolutely.
Yeah, which is one of those flawed strategies that we've talked about.
Actually, there's less and less people now talking about that because they've realized how flawed that is, especially in a climate like today. Yeah. That undoes a lot of property portfolios.
It's something that's, I think, spoken about more in the US than it is here, but it used to be a big thing here. There are still a couple of people that talk around living off equity.
See, the advantage in the US is you get 30-year fixed loans.
Correct.
Yeah. So you've got the cash flow down pat. We don't have that over here.
and non-recourse lending
Yes.
to some degree, which we do not have, which is why we've got a healthier banking system. So it's very hard to compare the both.
Yeah,
and we
that's true.
shouldn't.
That's
But
true.
just very quickly, why don't you explain to the listener, for those that don't know what it is, what living off equity is?
Look, I'm casting my mind back to one of the ads back during the days when we had magazines as property magazines, right? And I won't mention names, but there was a particular mob that used to really highlight this, where you bought 5 properties, right? They're all brand new properties, by the way, and the assumption was that each property would go up by 80k a year, go figure. And of that 80k, you could get 50k from each property. So once you've got your 5 properties, each year you'd go to property number 1, you take 50,000 out, you go out to your yacht, you go out holidaying, that's your lifestyle money for that year. Next year you go to property number 2, number 3, and by year 5, you're on property number 5. And year 6, you're coming back to property number 1. Couple of flaws over here. First of all, biggest flaw, you need to qualify for the finance. Right, back during those days, they were talking about low doc loans, the true low doc loans, where sign hard, press hard, you've got the money.
Yeah.
Then you've also, someone's got to make the repayments, right? And then the third is the assumption that your psyche will handle that ever escalating debt. And whichever way you look at it, this is flawed to the hilt.
There's the fourth point there, and that's the assumption that your property grows in this
In
linear
value, yeah.
sense, by 10% every
Linear growth.
Yeah. So and we did a podcast on this, I think, or a Facebook Live a couple of years ago, in and around the most flawed and dangerous strategy there is, and that is living off equity. Maybe we'll revisit that another time. All right. So
one of the things, Steve, while we at that is understanding the types of cash flow within the portfolio, right? One is the genuine cash flow. So this is where you budget money coming in. So this is your earned money plus the rent. That makes your cash flow, right? Whether it is positive, negative, by the time you take every expense into account, right? Then you've got the second type of quasi cash flow, which is your liquid equity. So that in the tough times, because you'll have each month you might not break even if you're down to one income, as an example, right? So this is where the quasi cash flow comes in. We're using a little bit of the equity to tear you over for that month, right? Now you're not making it habitual to make sure that you are, each month you're just simply dipping into the equity that you've released, and you start living large, right? Which is pretty much the same as living off the equity in that sense. The third way of creating cash flow really is, especially when you're getting into July, is talking to your accountant and getting your tax refunds on a pay cycle basis. Now, there are pros and cons to it. And again, between the two quasi cash flows, which is the liquefied equity and the getting your tax breaks early, if you're not disciplined with money, very dangerous strategies to have.
Yep, 100%. So I think discipline is the key takeaway.
Yeah.
There. All right, on to the next point. And that is, I guess, a going sideways or adding to your comment around there about living large a minute ago, and that's non-deductible debt. So non-deductible debt, in short, is things like your car loans, hire purchase, boat loans, Harvey Norman card, that's not a plug for them, or even a credit card.
Yep.
So anything that
Holiday.
Sorry?
Or holiday.
Yeah, and
that you've got on
experience.
credit.
Yeah, correct. So there's two types of debt that we often refer to. So that's deductible and non-deductible debt. And usually the deductible debt is associated with an appreciating asset of some way, shape or form. Yeah. So the problem with non-deductible debt, if we just strip out the deductibility component from it from a tax filter, because we're not talking about that. The problem with non-deductible debt is that the general rule of thumb is no matter whatever that debt number is, it takes away 5 times the amount of that number from your mortgage serviceability. So if you've got $50,000 worth of car loan, it's about $250,000, give or take, of serviceability for a property straight off the bat. And you throw in a $5,000 credit card, maybe some personal business expenses, et cetera, and very quickly you can be in the tune of hundreds and hundreds of thousands of dollars away from taken away from that overall potential serviceability calculation.
Yeah, there's two things that spring to mind over here, Steve, which are the biggest serviceability killers with most people, especially going to tax season now. One is the car leases, right? You get a novated lease, you'll pay it through your tax. It's all glorified, but that kills your borrowing capacity significantly. And then the other one is if you're getting close to your credit limit with your credit card, generally what the credit card provider does is automatically increase your credit limit. So you get a letter, nice warm letter saying, your credit limit was 12,000. We've reviewed your good repayment history and now it's 15,000. That 15,000 reflects directly to how much you can borrow to invest or even to build to buy your home.
And usually it's another credit hit as well. So that non-deductible piece is such a, I guess, crucial part of the jigsaw puzzle in and around lending. And this goes back to the earlier point around if you're looking to borrow in the future, start getting it right now. And you might find that the broker says you'll need to get rid of that credit card, or it might be a lender condition. But for me, often it's around, well, I don't want the lender to be dictating to me, we'll give you the money if you get rid of the credit card. I want to, well, I don't like credit cards, full stop. But if you've got them, it's
paid out in full.
Yeah, but exactly, paid out in full. But having the chat to the broker saying, listen, what have I got to do to get myself into a position to be able to borrow? Yes, it'll be based on today's circumstances, but I'm looking to do it, let's say, 6 months. Can you see anything that I have here in my assets and liabilities that I need to adjust? Is it a credit card? Is it this? Is it that? Is it a car loan? Whatever it may be. And I guess this is where, if you go back to the COVID glory in and around all but free money, and things like the car loans and the hire purchase stuff and the experiences, that's all coming home to roost now in terms of serviceability. Actually, I remember we were talking about it during COVID, just in and around credit cards for a second, that there was a point in time during COVID where credit card debt in Australia was its lowest it's ever been since we've been taking records in this country.
Totally.
Conversely, the report came out the other day, and we said this probably 12 months or more ago, said one of the key indicators to look for in the economy to see how hard it's struggling is keep an eye on the data in and around credit cards. If it starts to shoot up, the economy is shrinking. People are doing it tough. Interestingly enough, depending on what filter you put on it, credit card debt has gone through the roof in the last quarter.
So as a nation, we're not in recession, but per capita we are. Right? So people are struggling. Not struggling in the true sense, but there is wind taken out of the sails because cost of living is really high. And the fact that interest rates are on the way up still. So it does take a lot of wind out of the sails. Now, one of the things that you mentioned, Steve, which I think we need to circle back, is talking to the broker. Right? Most people start talking to the broker once they've found a property. And this is where they get it fundamentally wrong. You need to be talking to the broker. So there needs to be a pre-chat with the broker. Also with your property strategist as well, if you're investing. And that determines what you need to do before you put the application in. And then once the application's in, you've got the finance, you know how much deposits you've got, you know how much buffer you've got. That's when you start looking for a property. Most people do it in reverse. They look for a property, they find a property, then they try and jam finance in place and they run into trouble. The ATO stats came out, right? 2020. Guess how many property investors in Australia? 2.3 million. Right. Of that, 92% of the 2.3 million own 1 or 2 properties. Guess how many own more than 6? Hasn't changed much from the last stats we had. It's around 35,000. So that tells you that if you really want to invest successfully with the reality is, right, if we have one or two properties, we're not going to be really wealthy in that sense, right? So you need to have multiple good assets to make a difference in this lifetime. Otherwise, your kids are going to enjoy your sacrifices, right? So if you want to get into that 30,000 people, you got to do different to what this balance of 92% of the 2.3 million people are doing.
It's a good point, Vic, because very few people accumulate wealth or create wealth by accident. Very few people.
There has to be a planned approach.
Yeah, it is. It's planned, it's methodical, it's strategic, it's well thought through, and they activate and they're constantly active.
Yeah.
So if it's in and around finance, they're not, most of the time you're not being reactive. It's like, well, I know that I assess the market to be this and my circumstances to be that. I better start talking to the relevant people to put myself in a position to do it. Now, back in the day, there was, like in terms of shares, there was, fund managers and portfolio managers and advisors, and we're seeing that absolutely pivot now, or not pivot, but be replicated within our space.
Yeah.
Because it does need to be well thought through, and the broker is, or finance is the key element. And the last point, Vic, as we run out of time, is lender selection and asset selection.
I think that's the best one out of the lot.
I think it is too, because sometimes people will take any lender at any price, not knowing that they could be imprisoned with that particular lender with not much of an escape path for them until lending gets remarkably easier. And obviously which we'll get into in a minute, and obviously asset selection is very important, and I'll tie it in with what you said around the 35,000 odd people with more than six properties. I would hazard a guess on that point that there's a good deal of those people that have more than 6 properties bought for the sake of buying, and potentially their asset selection wasn't good. So I'll make it up. 12 properties in the one trick pony town. With a very low pool value or something like that, because it's more of an egocentric rather
That's right. They got caught up in the number of properties rather than the results.
Correct. So asset selection could also be in and around what the property produces for you. Have we pivoted to commercial at a point in time to
Increase
create
cash
flow, potentially therefore serviceability / livability? Or is it something where we've got ample cash flow and we need something more oriented around growth, whether we need to manufacture it or whatever it may be, so that we increase the equity position to harvest to then leverage and go again, and so on and so forth. So the combination, lender selection, needs to tie in with asset selection.
And what you're going to do with that asset.
And what you're going to do with that asset. So it could be an example, if I just make one up without mentioning any of the lenders' names. If your potential property purchase was that wanted to have a secondary income created or attached to it, so let's call it a granny flat or another property in behind it, whatever it may be, and you went with lender A might have the best rates and give you the most money, but lender A's appetite for that type of opportunity is not very good. So they might reduce your LVR position down to 65-70% because of their, policies. Whereas lender B, that might have a 25 basis points bigger cost of money, might have a greater appetite for that.
Or it may give you a better valuation.
Because
that's an asset they like.
Correct. So it's very important, once again, coming back to the broker, that the broker understands what potentially this next asset looks like and its type, what it produces, where its locality is, whether it's attached, detached, what postcode. All of this really is important so that the broker can select the right lender for you.
So full circle, you need to tell the story to the broker first, and then they get the finance. Not be focused on interest rate is important, but let's not get focused on interest rate. Get focused on the outcome you're after and how the lender can facilitate that outcome.
Very important. So the outcome also might be the exit strategy. So
easy to get in.
Yeah, easy to get in, but how hard is it to get out. Because there are certain lenders out there that are certainly more equitable when it comes to giving you money in today's environment, or any environment for that matter. But there's always a cause and effect.
Yeah.
So their rates, when rates start to go up, they go up a lot higher.
Because they know you can't refinance away.
Because where are you going to go?
Yeah.
Now, we're not talking about hard money or anything like that, or second mortgages, nothing like that. These are traditional lenders. And usually their narrative during the easier times is, we want to be recognised as a more traditional lender.
Yes.
And it's like, yeah, okay, that's a nice line, but we'll wait and see.
Leopard and spots.
Exactly. But so it's very important, once again, that we match the lender to the asset.
And what you're trying to do with it.
And what you're trying to do with it. Yeah, development, not buy and hold, renovation.
Yeah.
Yeah, how quickly can you revalue something? So, once it might not just be rate, as you mentioned, it's the policy and what their appetite for lending is.
Yeah, and generally when you are borrowing money, understand that you are actually putting yourself at risk, right? So you need to be looking at what the exit strategy is going to be for that lending and for that property. And if we look at the get out ahead of the get in, we really can't go wrong.
Oh, I like that. Look at the get out before you get in. It's a good one.
I know. I just pointed just now.
That brings us to the end of today's recorded podcast, the 5 absolute finance musts to protect and enhance your borrowing capacity, because it is the center of the universe. Without you got to buy the debt before you buy the asset.
Yeah,
it's as simple as that.
And I guess this is where we've talked about a lot of moving parts with finance, right? And the biggest takeaway that I've ever had in around finance is, don't get caught up with the millions that you owe. Get caught up with the dollars that you need to come up on a weekly basis to control those millions, because that millions controls the asset, right? So if you're unsure of what you need to do, or if you already got a portfolio and really you've been told by a broker that maybe you can't do anything, we're just a phone call away. We can have a look at your portfolio and set in the right direction. And like you said in the beginning, Steve, for some of you, it just simply is not possible. You got to sit this one out. But you need to explore all of the tricks and the little strategies within finance to be able to take advantage of today's market. So if you're wanting to get a start, or you've already got a portfolio, just reach out to us. Just go onto our website, rightpropertygroup.com.au. Again, there's a process. If you're already an existing client, you got to talk to Melanie or Jenny. They'll set a time in our diary. There is a bit of pre-work that you do need to do. In other words, you need to know your numbers so that you can divulge that to us. So you need to plug in all of the numbers in the Google tracker that we give you. And if you're new to us, or you've been listening to us for a little while, and you've decided now's the time I need to explore, you'll be talking to Melissa first. Now, Melissa's a really accomplished property investor. She's seen multiple property cycles, and her role is to first of all get you ready for a meeting with either myself or Steve, so that you can then ask the right questions and you get the best of our time together.
It's pretty simple, really, isn't it?
It is.
Alrighty, that's it, folks, for another Investing Insights with Victor Kumar and Steve Waters. And if you did like this, give us a rating, because there's a lot of people that put a lot of effort into this, and we love the feedback, good, bad, or ugly. And we will see you next fortnight.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.